Hi, my name is Mitch Kramer, and joining me on the January 24 webinar is Trey, Talley, the portfolio manager. We're going to be talking about what we see happening in the markets, the economic format, touched a little bit on the political scene, and more importantly, what we're doing to protect and grow your money. There's some information we're going to share with you guys today that potentially could be scary. The reason I say that is we've been positioning all our portfolios for the past year to be in a conservative position, waiting for a pending recession. And a lot of people have asked us, well, we didn't have a recession last year, and the markets went up, and it's mainly due to seven tech stocks. What happened? And probably the quick answer to that, and Trey can add to this, is that when the federal government spends money, it's a huge stimulus to our economy. And when the Inflation Reduction Act, which is kind of an oxymoron term, and the CHIPS Act were passed, it takes anywhere from 6 to 8 quarters before that money actually enters the system. Well, guess what? The money hit in 23, and that basically kept the stock market and the overall economy buoyed and kept them above water. That federal stimulus has now been spent, and it will not be there in 24 to support the markets. And so when that gets pulled away, what do you have left? You have a consumer who is stretched. You have record levels of credit card debt. You have a labor market that's deteriorating. So that's kind of the backdrop. So we're not trying to be perma bears or just say the sky's falling. It's not the case. But unfortunately, our media outlets, for the most part, are not telling you the full truth. They're practicing self-censorship of bad information. Why? Yeah, who knows? I don't know what the motivations are in newsrooms, maybe because it's an election year. But anyway, we're going to go through and share some information with you that's fact-based. And when it's safe to go back in the water and incur risk, we will do that with our portfolios. But now is not the time to go and take risk. So Trey, do you want to add anything?
Yeah, thanks, Mitch. So, hello, everyone. And yeah, so 2024 succinctly will be what 2023 should have been. And a lot of the support that came through in 23 will not be present this year in 24. There'll be some opportunities along the way, but things will likely be a bit more, we'll likely experience a bit more turbulence. But 2024 is going to be characterized by a U.S. consumer-led recession, a slowdown in business investment, and the expiration of that fiscal support Mitch was talking about is going to compound that downturn. So it really sets the theme for this year, which is kind of antithetical to a lot of the headlines that we see, but we'll kind of walk everybody through it.
Yeah. So the first slide, the information presented is by myself and Trey in Fluent Financial, not Private Client Services or broker-dealer. Trey, why don't you talk a little bit about market performance through the 17th of, is that last year or is that this year?
So yeah, so just January 17th of this year here. So this is kind of the bear market. Some of these indices are still in that bear market. Small caps, which are very leveraged to the economy, are still down over 12% over this time. NASDAQ going through, 2022 was the worst indice to be in. 2023 it was the best indice to be in. Funny how that works. So this is just a picture of the markets here. We're going to talk about a number of things today. We'll revisit kind of where we are in the hope cycle. Again, that's kind of when weakness comes about in the economy. Where does it hit first and how does it cascade through? We're going to revisit some of the developments in the Middle East. Taiwan had some elections that we want to talk about for just a brief moment, and some of the recent employment data. Some of it's pretty intriguing. Markets are optimistic on rate cuts this year. We do think rate cuts are coming down the pipeline, but both in magnitude and speed, they're going to be a little underwhelming. And the markets are just weighing that against some of the softening we're seeing in the economy.
So I'll take this next slide, Trey, the leading economic indicator index, and this is one that we've been sharing on a pretty regular basis. And you look back at the 9 past recessions, which are represented by the vertical red bars, the leading economic indicators always went negative, and then we had a recession. But what's been really interesting is you look at this high point here, and this was July of 22, and now it's been underwater at negative 7.6 for what, 20 months now, Trey?
Yeah, so we peaked 20 months ago for this leading economic indicator here, and the average from peak of that cycle to the onset of a recession is about 14 months. So we are kind of in a protracted cycle here. The Great Financial Crisis did take 21 months to enter that recession there. So we're not in uncharted territory, but it is a protracted cycle.
Yep. And so now let's take a look at how our portfolios did in the markets for 23.
Yeah, so 2023 was in many ways a mirror opposite of 2022. And so a couple of interesting things here. So on the left, we always put a couple of indices, some of them benchmarks here. So the Dow and the Russell, those are very tied to the economy. Those are about 15%. And on the opposite end of the spectrum, you had the NASDAQ, which was up almost 42%. Last year. Really strong year for tech stocks, predominantly about 7. There's a magnificent 7 that we keep hearing about. Equal weight, that's where everybody in the S&P 500 gets an equal weighting. They were down, or excuse me, they were up just mid 13% there. So that's showing kind of some of the weak breadth. It was concentrated in tech names. The broader market, the average stock didn't really do too much last year. The bond market was up just a pennants of 4.6%. Something interesting is that the second line item there is ACWI index, and so that's just the world index. Actually, what we've seen for the past 2 years is global indices are kind of really staying on par with domestic indices in terms of performance. So that's something we haven't seen in a while. So international performance is holding up quite well. We do think that maybe extends through the next several years. We contrast that with our portfolios. And so we were defensively positioned all year. So we lagged the market a little bit there. Some of those models do covered calls. 2023 is a year, for a reminder, that covered calls in a very volatile environment. You sacrifice some of that growth for yield. But most of our portfolios, a few of them did beat the benchmark. We hung in there, and ultimately we kept capital very safe and preserved. And so we're kind of proud of some of those numbers there. But year to date, we're contrasting it. Markets are on the back foot a little bit here to start the year. Some tax selling from last year, just the deferral of those gains spilling over. Interest rates are coming back up along with the dollar, so financial conditions are tightening up a little bit. We think that's going to be a theme for Q1. Strong market last year. We do think that that's going to be a juxtaposed to this year. It's going to look quite different.
So let's talk a little bit about the hope slide. And this is a slide we also have shown on a regular basis for a while. We are now in the last part of it, which is employment, and we're starting to see some breaking down the employment sector. So Trey, why don't you just kind of talk briefly about the different segments of it?
Yep. So hope cycle here, again, we're looking at when weakness hits the economy, when the Fed starts hiking interest rates, trying to slow things down, what gets hit first, and then what gets hit last. So housing is one of the first things that was hit. We can see that here at the early part of 2022. Housing is still having a tough go at it. This is home builder sentiment here. Anything below 50 is contractionary. We've been there for most of the balance of these prior 2 years. So home builders, new homes are doing all right, but existing sales are really suffering here. Everybody's got the golden handcuffs of low interest rates. Nobody really wants to roll into higher debt. Plus, home prices are really high, so it's slowing down activity there. Building permits is one of the other things we look at for housing. It has also not been immune to those higher interest rates. It is having a little better go with building permits, especially through 2023. It was like a record construction boom in multifamily. Of course, that's all come online now. So there's almost a surplus of multifamily inventory out there, and that's going to do a lot of things for prices as well. Building permits holding it a bit better, but still experiencing some of that pain. Mm-hmm.
And look at new orders in terms of manufacturing and then services.
Yep. So purchasing manager activity here, that's what we're looking at. Supply chains obviously very lagged. So this is manufacturing. It is still in contractionary territory. It's been there for about 12 months. And so new orders are contracting in the manufacturing section of the economy. Manufacturing is still in a recession. The hope was that manufacturing can become, gain some life here as services starts to abate. We've really not seen any palpable recovery in manufacturing, and services is experiencing a lot of those ailments now that manufacturing was through 23 and 22. And so when we look at services on the next slide here, new orders just continually sliding down. We're still expanding. Consumers have really gone on kind of a credit binge here, and they're record amounts of personal consumption. But ultimately, it's kind of running out of fumes, and services is just heading towards below 50 there. That'll be a contraction. That's usually a really great signal for the onset of a recession. So we're inching closer to that here.
We're seeing profits roll lower. You actually can see this dip. It's much more significant this month than it has been the prior two.
Yeah, so corporate profits here, that's what we're looking at. It's just earnings per share for the S&P 500. So they're down just about 2% or so off of their highs. Corporations did a lot last year at the tail end of 2022 to protect earnings. They cut R&D and CapEx. They're trying to do passive layoffs to try and manage their head count, squeezing every bit of profitability they can. But earnings are not immune to high interest rates and high prices that we've been experiencing. They are turning lower. We expect that trend to continue.
And the reason why this is important, if profits go down, how can the stock go up? Because people want to invest in companies that are making money and growing money, not having reduced profits or having losses. So this will have a bearing on the stock market, and it's probably why we're seeing some of that retraction in the first part of this year. So let's rotate over to employment.
Yeah, so employment, this is where the area of focus is now. This tends to be the most volatile piece of kind of the roadmap for stocks. And so initial claims, it's still holding in there. Mostly companies are just initiating layoffs by a passive style. And so early retirements, job switchers, but hiring activity has been quite benign. And so initial claims is not spiking yet. There's kind of, everybody's, I don't want to call it colluding, but there's kind of, there is some collusive effect from companies to not try and release all their labor quite yet, hoping that we can get to the other side of these high interest rates. But we expect that floodgate to open in 2024 as profitability gets crunched and they have no other option. So initial claims still quite low, but unemployment has been rising. And so it's off the low there. It has ticked up to about 3.9%, down to 3.7% most recently. Notable about that is the unemployment rate declined from 3.9 to 3.7 in kind of the worst way possible. The labor force participation rates actually dipped lower. And so people, as the duration of unemployment is extending. And some people are just saying, you know what, I'll just sit on the sidelines. I'm tired of looking for a job. I can't find a job. Nobody's really hiring right now. And so people are leaving the workforce. We had several 100,000 people leave the workforce over December month there. So those tend to be more difficult problems to solve. You have to entice people back in there. So if you have a declining labor force and an inclining unemployment rate, that tends to be a pretty nasty cocktail for the economy. But we do think this is the area of focus. We think 2024 is going to be all about jobs. And it's not going to be a light switch, but we do think that unemployment is going to tick higher from here.
Yeah, and there's some slides we'll go through here in a little bit that shows even more detail, and it kind of goes in more detail about the concerns that we have with the overall economy. So let's shift gears and look at the inflation picture, Trey.
So inflation's kind of been moving along the floor here since headline inflation since about the middle of 2023. So most current read on headline inflation was about 3.4% rounded. As you can see there from the different colored bars there, most of the inflation is coming from the core services piece of the economy. There's still a small food element. What has happened since about the middle of 23 is the energy deflation that was helping pull headline inflation down, that red bar, it is slowly compressing. And so that is not subtracting from CPI as much as it was in the early part of 23. So we're kind of the last mile of inflation. We do believe that inflation continues to go away. The elements of a double bump in inflation like we saw in the 70s have not manifested, but that does not mean that inflation is going to go away tomorrow or in a straight line. The Fed still has some work to do here. Wages are going to keep these prices pretty sticky for the balance of 24. Bond yields will need to be paying attention to what happens with inflation. There are a number of other catalysts that are going on here, but it's too early to declare victory on inflation yet, but we are making progress.
At one point, I think it's interesting, ties back to one of your former slides on building permits and multifamily. With the big amount of surplus inventory of apartments that have been added to the market price, you're starting to see landlords cut rent. I know for our space here, we're actually commercial real estate. What they wanted us to renew a year and a half ago is about $1.50 a foot less now. So we're starting to see rate cuts in the rental space, and that's going to also help in the core services area with inflation. But I agree with Trey. The last percent or so of inflation, or two, to get it down to 2%, is going to take a lot longer. It's a lot harder than going from the 9% peak it was at. So let's talk a little bit about the Taiwan elections. This is kind of significant because Xi, the premier of China, his tenure, he basically wants to have Taiwan come underneath his wing. And everyone remembers the Hong Kong situation a few years ago, where Hong Kong was supposed to be independent to 2049, but Xi didn't like that, so he took it over, and basically it's like the Borg, you will be assimilated. So Hong Kong's going to be a communist entity. And they like to do the same thing with Taiwan without firing a bullet. But for them to do that, what they'd like to do is have their people from the inside have political power. And what happened in the election, Lei Jing-tai, if I'm pronouncing it correctly, of the Progressive Party, who's been the party in power, retained control and power. Beijing, or China's preferred candidate, was from the conservative KMT party, which wants to reunify with China, lost the election. There's this new party that kind of wants to keep things the status quo. The significance is because this party's in control, it's more pro-independence, pro-U.S., which Xi's not happy about. If this party had won the KMT party, there could have been a risk of unification of Taiwan with China much sooner. So it's going to be another 4 or 5 years before this gets addressed. Now, the DPP party here did lose some seats in their respective Congress, so their power and authority was weakened. But this is something we're paying close attention to because this could be another geopolitical hotspot. If we go look at the presidential election potentials, these are polls from Real Clear Politics. We're going to most likely have a rematch of Trump versus Biden. And talk to people, 330 Americans in this world, in this country, and these are the two candidates we get to pick from. How does this happen? Who knows what's going to happen in this election? But it's really very, very close. It's hard to predict. Depending on what your news sources are, will dictate who their candidate favorite is. Trump has got a very, very marginal lead now. The mail-in balloting is very apt for fraud, and there was some of that in 2020. There's been dozens of court cases of people who have been convicted of voter fraud that's not being reported. Ideally, you better have better security, but it's not going to happen. But it's just going to be a mess. The important point to realize is, regardless who wins the election this fall, 330 million Americans have much more of a say what's going to happen with the economy and markets than either President Trump or President Biden. Okay. Trey, why don't you talk a little bit about the impact of the Middle East and what we're seeing in the spike of shipping goods prices because of the Houthi rebels?
Yeah, so the rebels here have kind of taken the Red Sea passage as hostage at this point. They fired on a number of ships, some of them being U.S. flagged ships. And what's ultimately happened is trade has had to reroute around Africa, which does raise shipping costs. It raises lead times, and ultimately can be inflationary. This was a big part of the goods inflation that we saw initially coming out of COVID through 2021. So this chart here is just looking at some of the main indices for shipping. And so you can see through 2021 and 2022, both the ramp up in those shipping rates and then the kind of the fall. That was going to mirror largely what you've seen in inflation. Well, most recently, a lot of them have started to turn higher. Some of these indices are up over 100% in just a month's time. So shipping costs are being raised. That's the Fed is paying attention to this. They have talked about this as a potential for a small little bump back up in inflation. We're watching that as well. Could affect stocks and bonds, which we're allocated to. So we've made sure that we've shored up our energy exposure. So if we do see an energy spike here, that we will be hedged for that and we'll be able to participate in that. So something we want to definitely keep an eye on. It could have a number of implications here in the near future.
And while we're talking about international, there's been some divergence of indebtedness in what the various major parts of the economy are doing in our country versus the European Eurozone. So our debt to GDP is continuing to go up, and this is going to continue to be a problem because when you use debt, you can initially profit from that additional leverage, but when debt becomes so cumbersome, it starts to crowd out the capital available and actually acts as a drag on growth. The Europeans are much more restrictive on the kind of debt that they run. Germany's kind of the 800-pound gorilla in Europe, and they've got very strict rules about running budget deficits. So that will probably benefit Europe longer term. We have to have some significant reduction of debt in this country. One of the biggest problems we've had with this administration is they have passed so many big spending bills that we're spending money as if we were in World War II with all this spending, and it's not sustainable. Both parties have responsibility for this. It's not just the Biden and the Democrats. Republicans had to sign off on this, but it's not sustainable. It could create bigger problems down the road. Trey, if I'm correct, aren't we going to be spending $1 trillion in this fiscal year just for interest payments on our debt?
Yeah, so the interest payments going into 2024 are forecasted to be more than the actual defense budget. So we're going to be spending more money on servicing our debt than we are defending our country. We've got to have austerity here. There are a number of ways we can do it, but there is diminishing marginal utility to debt, like Mitch was talking about. And the U.S. has just got to figure out a different way because we can't just grow ourselves out of it, and we can't just keep kicking it down to next generations. So it is a risk that we're there. Now, don't go buy bunkers or anything like that. We're not there yet. We're still the cleanest shirt in the dirty laundry pile, but it's some dirty laundry.
All right, so the next chart, and this is about unemployment, and we're going to be talking about some slides here coming up that kind of highlight what we were concerned about. Unemployment breath is spreading. So when you look at this chart, this goes back from 1990 all the way into November of 23, and then you look at this index here, and you can see the percentage of the top 400 U.S. metropolitan areas in the country, and they have rising unemployment. So you can see this spike up here. And when you see spikes at this level, as you come across and say, when was it this high? Well, here's the COVID recession. Here's the Great Recession. This is the dot-com recession. And this is Gulf War, I recession here. So we're approaching levels of recessionary pressure on unemployment. Now, this next slide, I'll let Trey talk a little bit about the household employment drops. Because I think what's important in this slide is this statistic is misconstrued and not used properly in the media about really what's going on with household employment.
Yeah, so this we've got a couple of charts here, I think 3 that we're going to run through. So these are kind of some anomalies that popped up through December. And so this chart here that we're looking at is a payroll report. And so the yellow line is kind of the government statistics, most popular and very robust data series of payroll employment. It showed we created 216,000 jobs. Now, there's also a private payrolls report, a slight difference in methodology, and that is that blue line that you see there. The white line is also just kind of trying to bridge the two together. But what you'll see is the government said we created 216,000 jobs in December. And what we saw in kind of the private payrolls report was actually a reduction in almost 750,000 jobs in December alone. So this data series is subject to a bit of volatility, but that decline in jobs was the greatest since April of 2020. And so what we would like to say is we would like to see January's numbers build more of a confirmation. But this was a pretty stark signal. We're getting a number of other signals here, but there's something that happened in employment with December. And it seems like it really kind of found a trap door there. So without an immediate reversal there, there's a potential that the layoff cycle is here and enforced quite heavily. One of the other charts that came through in December was this next one here. So kind of relatedly to that employment report was the ISM services. So if you remember, as part of the hope slide, we use the ISM services new orders. So that's just a survey of tens of thousands of purchasing managers in the U.S. And they split this into a sub-index here. And this one is for employment. And so what you'll see is a reading of 43 in change here on this one. So again, anything below 50 is contraction. Well, this thing was, just modestly above 50 here. This was the largest contraction almost on record. And the degree to which this employment statistic has declined was greater than any metric we saw during the tech bubble. And it was so much so that the Bloomberg economists here, when we were speaking with them, they said that they had reached out to ISM and wanted to clarify whether it was a data error or if somebody had fat fingered something. And so the ISM actually replied back to Bloomberg and indicated, no, it is a true series. This was what happened. We triple checked the numbers. And so they did a number of other kind of corroborating statistics, and it kind of found something similar. So with the other one, with the prior chart, we'd like to see January's data just to see if it's a blip. But a real big, deep contraction here in employment activity. And this is for services. This is the area of the economy that's been holding up well. So it's something we definitely want to be keeping an eye on here. So the last anomaly chart that came through in December was this one here, and it's on the manufacturing side. So this is a Federal Reserve survey here, and they do this for the New York district. And so this is trying to survey different manufacturing businesses and trying to report how many of them and to what degree are they improving or declining business conditions. And so we saw a jump from about 15 down to over 43, negative 43 in this metric here. And so that's indicating, again, this was a decline that only the sharp deceleration of COVID, that was the only time we saw this type of reading in this data series going back over 25 years. And so not through the great financial crisis, not through the tech bubble, did we see this sort of decline in manufacturing activity through New York. So it's worth note. It is, again, with all of these, the disclaimer is that we've seen a bit of volatility with them, and we want to wait. We don't want to jump to conclusions. This was another metric that jumped through in December. Again, a lot of things jumped up in December that really caught a lot of people off guard. And so we'll wait for confirmation, but it really shows that manufacturing not only continues to be in a recession, but maybe taking another leg lower.
Yeah, some really good points, Trey. And again, I think the important message from these three slides is we have three data points that are very negative and concerning. Is it a blip or is it a new trend? We'll find that out here in the next couple of 3 weeks. So let's shift gears. We talked a little bit about the boost in federal spending that kind of buoyed our economy. So when you look at this chart, this is the first quarter of 21 all the way to the third quarter of 23. And you look at contributions to GDP growth. And these color charts, and the ones I want you to focus on, government and expenditure, which is yellow, and personal consumption, which is red. And again, personal consumption represents about 2/3 of our GDP. So part of this is the government spends money, then people have money to spend. So that represents this. And then the private investment is just businesses that are investing. But this yellow that you see here going on for a good part of this year or last year has been the government spending that's been buoying our economy. Trey, you had, and this is really, really important, 2/3 of the GDP growth, 4% of the 6% growth last year was due to federal government spending. And that's not sustainable. And this year, because it's not going to be there, it's going to be a negative 1% drag on GDP. And we've already shared with you, employment's weak, profit margins are weak, earnings per share is weak. How do we avoid a recession? And people that say, oh, we're going to have a soft landing or there's going to be no landing, oh, we're just going to plow right through this. I don't know if those people are looking at what data it is or what talking points they're reading, but it's not reality. So Trey, anything you want to add to that?
Yeah, I just think that's so important. There were a number of things that kicked in last year that reaccelerated the economy. The biggest one being federal government spending. Again, 2/3 of the growth we saw in the economy last year was from federal government spending. That is almost worth repeating multiple times just to really let it sink in. But even more importantly, looking forward this year to 2024, again, it's supposed to be a drag on GDP growth. And so the Biden, I don't want to say Biden administration, because it wasn't just solely them, but the administration really did a great job of deferring the recession that was going to take place in 23. You can't delay, you can delay a recession, but you can't cancel one. And so at this point here, we really don't see that. We don't really see any fiscal impulse coming through this year. It's expected to be a drag. But we see a strong Republicans in Congress. They have a de facto veto on any election-geared spending bumps. In general, political gridlock is likely to generate flat to slightly negative fiscal impulse this year. So the big boost in the economy that happened last year is not going to happen this year. It's not. Perhaps consumers can continue to remain strong. That's the red portion of the bars there in GDP, that personal consumption. But you would need to believe that the consumer will find a way to sustain that spending level that happened in 2023, which was two things, a drawdown in their savings and an increase in their credit card balances. And so that could happen for some time, but not indefinitely. And even taking that position, you delay a recession, but you probably get a deeper one because of the debt accumulation. And so we think 2024 will be what 2023 should have been. And we to take the counter argument that we're not going to have a recession is really just saying that all the leading indicators and cyclical signals, which point unambiguously to a recession, have broken down. And that means that the yield curve inversion means nothing. That means that the leading indicators are broken. And I've heard crazy things lately, like the business cycle is canceled and the interest rates don't matter.
But Trey, this time it's different, right?
I've heard that plenty of times, and oh, those are so dangerous. Those are such dangerous words. Again, it's not anything doomsayer, but this is generally how it always happens. Again, people knew things were crazy in 2000, but then we were like, you know what? The stock market keeps going up. Maybe technology is going to solve all the world's problems, and then whoop, rug pull. And then the same thing happened in the Great Financial Crisis, where you started to see all the leverage in the housing activity. You said, well, housing prices have never fallen. We're going to be fine. Again, Ben Bernanke's subprime is contained speech was in January of 2007. And so that proved to not be the case there. And now you hear the same type of rhetoric as markets are hitting highs. And as the economy is really starting to actually contract here in important places and employment's falling apart. And so I think it's just a really dangerous time. And so when we've done our reassessment, we come back to the same conclusion. We've tried to try and figure out, is there a way we can get bullish? And really not. The economy and under the hood of the market continues to deteriorate. And I think that this is a dangerous time here as sentiment is really stretched. Valuations are as expensive as they've been over in 20 years previous to the pandemic there. So and growth here, as Mitch is kind of showing, growth is estimated to start to decelerate into next year. So this is GDP here. Dark blue bars is what has happened with GDP, and kind of the lighter green blue line there is the forecasted GDP. So we do see that deceleration starting to come through, and so it's a time to be vigilant here and not to be careless. So.
Yeah, and then the other issue is the amount of debt, the debt maturity walls. I mean, we talked about the lack of houses for sale because people are kind of house handcuffed with either no mortgage or very low mortgage interest rate. So you want to get a mortgage now, you're going to pay 6, 7, 8%. And the house is maybe artificially high right now. But on the commercial side of it, a lot of these loans have, 5-year maturities. they're going to be coming due and they're going to have to be refinanced in this higher interest rate environment. And we've already shown earlier that margins are getting squeezed by companies. Now you got to add on higher interest payments. A lot of these companies may not be able to sustain that without having losses, which will have a negative impact on the stock price.
Yeah, so this chart here, it's kind of just breaking out high yield and investment grade, and the bars here just 2024, 25, and 26. Just trying to show how much debt is going to come due in these respective years. In simple terms, about 25% of the total credit market is going to come due in the next 3 years. Some of that is already being rolled forward. They lead that a little bit. In dollar terms, that's almost $2 trillion that's going to be rolled over from basically, zero interest rate debt. There's a spread on top of it into some of the highest interest rates that we've seen in over a decade. And so that is, we've already seen net interest coverage ratios for the S&P and a number of indices start to fall. That's going to really start to seep in and affect the interest rate. And so there's a lot of headwinds that are coming in 2024. That's why the market was kind of optimistic that maybe we can get rate cuts before some of this happens. We've talked about inflation sticking around a little longer than we'd like it to, and that means that higher rates will probably stick around as well.
And speaking of interest rates, the current market interest rate projections, again, this is a slide we show on a regular basis. The Fed funds rates at 5.25% to 5.5%. This is when the Fed will be meeting. And across the board here, the expectation is that they're going to cut rates at every meeting until we get to December. Some people said there may be only 3 rate cuts of 25 basis points or 0.25%. Some people have said if we do have a recession, they may cut rates 3 percentage points or 300 basis points. So you would go from here all the way down to here. And that may happen if we have a recession or it's worse. So somewhere between 75 basis points and 300 basis points is what we can probably expect this year. We talked about inflation being a little bit more sticky, but I do think inflation will come down. The Fed's going to be under pressure to cut rates. Again, it's an election year, and politicians, what they love more than anything else is power, and they want to stay in power as long as they can. So there'll definitely be pressure on the Fed from the politicians to cut rates so the economy's in the best shape possible when November rolls around. As we kind of wrap up, one of the things I wanted to point out, these are our option-heavy portfolios, and this is what we tell clients what we're going to produce on $1 million. This is what we actually did for last year. So we were able to beat all the metrics, and we're able to produce more income. I think the significant takeaway from this slide is over 25% of stock income's portfolio was invested in 30-day T-bills last year, and we're still able to produce just under 8.5% interest. And yeah, the portfolio return was not great last year, but we were able to generate the income. And that's what that portfolio is designed to do. When it's more of a risk-on trade, we're going to have more of that money in stocks, which would probably boost that yield a little bit and have greater returns. ADV, which is small cap and has NASDAQ and S&P, had a much greater yield because the tech sector of ADV helped boost that yield pretty significantly. So this kind of wraps up the webinar. I'm going to go ahead and turn off the recording, and we'll open this up to questions.